What's up, everybody? Crypto Noah back with another video. This is another video in my passive income war series where I compare yield farming to other forms of passive income. In this video, we're going to be comparing yield farming to bonds. If you watched my first one where we compare yield farming to real estate and we're specifically talking about multifamily and residential rentals, I created a chart where I have green, yellow, and red. Green means it's really good. Red means it's not so good. So I'm gonna break down what a bond is. I'm gonna break down what yield farming is, and we're gonna compare and contrast. And at the end of the video, I'm gonna give my unbiased thoughts on when you should be yield farming and when you should be owning bonds. All right. So before we get into it, I do have to say none of this is financial advice. These are my own perspective, research, and opinions, and should be treated as such. So without further ado, let's jump straight into it. Starting off with what is yield farming and what is a bond. So yield farming is just market making in crypto. Right? You have multiple ways to get a yield. You can do staking on a blockchain staking contract like E2.0 and get a yield. You can loan out your funds on a money market platform and get a yield when the platform lends it out. You can stake your liquidity on insurance platforms like Nexus Mutual and get paid from insurance premiums. And the most profitable way, the way that we always talk about on this channel, is staking your liquidity or your crypto tokens in the form of pairs on decentralized exchanges. And you get paid passive income anytime the two assets are traded back and forth. Like for example, ETHUSDC, you can also pick a price range whereby you want your liquidity to be used, right? This has been going on in traditional finance since the dawn of markets. There are market makers in stock markets, bond markets, commodity markets, crypto markets, Forex markets, literally all markets, precious metals, all of them. Okay, now we know what yield farming is. Let's talk about what is a bond. So a bond is basically a way to raise capital. There are two main ways to raise capital. Equity, where you give up equity in a company in exchange for the capital, or debt. And this is where a bond comes in. So it's almost like a loan. So if I were a company and I wanted to raise money via debt, I can start issuing bonds. So let's say I want to raise $100,000 and I want to issue 100 bonds at $1,000 each. A bond will come with what's called a coupon rate. There are zero coupon bonds as well, but the coupon rate is where you get the passive income. They call it fixed income, right? So if I'm trying to raise $100,000, I might put a 5% yield on there, and the bond comes with a term. So I could put 5 years. So that means if I issue bonds for $1,000 and it's a 5% coupon rate for 5 years, that means you'll make you'll get your money back plus 5% in 5 years. Now, if that company goes to issue new bonds and the interest rates drop or they raise, it can fluctuate and it can change the price of the bond. So the price of the bond can go up as well. And you can kind of look at this as impermanent loss. We'll get into that later. But there are many different kinds of bonds. You have corporate bonds where corporations issue bonds. You have government bonds where, these are U.S. treasuries. And then you also have treasury inflated protected securities where the fixed income or the yield rises and falls with inflation. You also have municipal bonds. So cities and municipalities will issue bonds to build parks and roads and all kinds of things like that. You have junk bonds. And obviously, the higher the yield on the bond, the higher the risk. And this is why junk bonds pay out really, really well. And U.S. treasuries, they don't pay out as much, but you can probably rest assured that the U.S. government is going to pay you back because they're in bed with the Federal Reserve and they essentially print money. Okay. All right. So here we are on our chart. We're going to go through the barriers of entry, which is how easy it is to buy it, the time frame, how long it takes to buy it, the passive income, like how much passive income can you get based off of how much you buy, how well it can be used as collateral, cash flow stability, meaning how long you can bank on getting the passive income, saturation, which is self-explanatory, risk of loss, and long-term stability of just the industries of yield farming and bonds in general. All right, so starting with barriers to entry, we have high on bonds and high on yield farming. Let's elaborate. So we have bond as high because it's pretty easy to buy a bond, assuming you're a U.S. citizen, right? You can purchase them from a broker or a government website. You can purchase them through mutual funds, and you can buy as little as $25. It's not like real estate where you need to do all this stuff. I mean, yeah, you have to create a brokerage account, do some KYC, but from start to finish, you can probably do it within a day. Yield farming is also pretty high because it doesn't matter who or where you are. I would say yield farm is actually a little higher because the barriers to entry is a little lower. You can be anywhere in the world And you can start with less than $25. You can start with $5. You just want to make sure the network you on, you have enough money to cover gas fees. All you need is a smartphone to be able to buy crypto. There are more smartphones than there are people. So it's extremely easy to get started with yield farming. You just have to learn. All right, the next one is the time frame. How long does it take to buy both of these? I have it marked as high on bonds and yield farming. Let's elaborate. So for bonds, you can buy them 24/7 online, depending on the type, right? So it doesn't take long to buy it. Like I said, you just have to get your brokerage account set up. Yield farming from start to finish, a few hours. If you know what you're doing, a couple minutes. You have to set up a MetaMask account or a Ravi wallet, set up a Coinbase exchange account or some kind of centralized exchange account where you can buy the crypto with fiat. Then you just send the crypto to your wallet that you just made, and then you can enter into liquidity pools immediately. Now, if you don't know what you're doing, obviously it's going to be a steep learning curve. And if you're interested in learning how to yield farm like a professional market maker and deploy the same profitable strategies that they've been deploying since the dawn of markets with expert coaches and an expert community, click the link in the description, book a free strategy session. We'll see if our program is a good fit for you. If it's not, we're happy to answer any questions you may have and point you in the right direction. I digress. All right, next we're going to be talking about the passive income, the cash flow. Is it worth it, damn? Like, is it worth it? Bonds, I have it as low. Yield farming, I have it as high. Let's elaborate. Okay, so with bonds, there are multiple strategies. You can sell the bonds or you can just get the fixed income or both. And it's the same with crypto, but we're strictly talking about the cash flow, all right? With yield farming, it's passive income. With bonds, it's fixed income, but it's also passive. And the level of degree of trust in the fixed income depends on the type of bond. Like I said, there are risky bonds and there are more, trustworthy bonds, whatever you want to call it. So you can see right now the treasury yield is around 3.9, 3.7, and these are 30-year bonds, 10-year bonds, 5-year bonds, 2-year bonds. And if you look at the 1-month bonds, you can see that the yield on treasury bonds for 1 month is 5.52%. And right now, the federal funds rate is 5.33%. So a lot of people get into bonds at high interest rate environments because they take a risk off approach. And this is why, bonds are more favorable in times like these. Because, you saw what happened with the stock market yesterday. It dropped like 6%, $2 trillion wiped out because of the Japanese yen carry trade and a bunch of other things. We made a video on that on the Know It Owl's YouTube channel, so feel free to check that out. Links in the description. And then these are some corporate bonds. These are the top 10 corporate bond yields right now. So you see you got 5.2, 4.7, 6.5, 4, 5. So around 4 to 5.5%. If it was up to me, I would rather invest into a treasury bond because it's safer than investing into a company. So here's the top 50 municipal bond yields. You can see that the returns 1 year, 0.2, 0.3. These are bond funds, right? 0.1. And they have billions in assets under management getting these kind of returns. I mean, shit, you could have got a higher return if you just bought treasury bonds. I don't know what the hell they're doing, but I'm sure it's something I don't know. Now, bonds are one of the most liquid markets in the world. So it's good if you have like lots of liquidity. And you can look at liquidity as like a swimming pool. And you can look at money as like a fish. If you have a small pool, you're not going to be able to put all of your fish in there, right? They're not going to be able to swim around. They can't move. And it's harder to go unseen in there. Because a lot of large institutions, they don't want other institutions or people or companies knowing what they're buying. So if it's an ocean, now they can hide their big fish. You don't know what they're doing, where they're swimming, what direction that they're going. So bonds is good. You have a high amounts of liquidity. Eventually, yield farming will get there, but we are in the dial-up stages of blockchain technology. All right, now, so I showed you some of the bond yields. Now I'm going to show you some of the highest yields that you can get in DeFi via yield farming on decentralized exchanges. This is our custom tool that comes with the membership. If you get a premium membership, if you just want to get access to the tool, it's $1,000 per year. And I did make a video showing this entire tool. Link is in the description if you're interested in that. But you can see the yields here: 2,000% APR, 1,400%, 1,000, 800, 750, 710, 600. Like, remember, bonds were the highest one I saw on the bond yield was 6%. I'm all the way at the bottom, and we're still in triple digits. We just got out of triple digits: 90%, 70%, 50%. If I go all the way to the bottom, now it starting to look like them bond yields, right? But most of the good pools, you can get a pretty good yield on at a pretty low risk. And the reason why is because the same mainstream institutions that's providing all the liquidity, doing all the market making in the traditional financial system, they're not legally allowed to provide liquidity in DeFi. And that's why, from a risk adjusted basis, yield farming is the best way to generate passive income in the history of the world. There's never been a time where everyday people like you and I can be market makers, okay? And that's why we started this group, because we wanted to help people take advantage of the opportunity while it still exists in this capacity. I say we probably have around 3 years until institutions are granted the regulatory green light. Probably less if Donald Trump gets in. All right, the next one is collateral use. How easy is it to use it as collateral and borrow against it? Right? With bonds, I have it as high. Yield farming, I have it as low. Let's elaborate. So we have bonds as high because, if you didn't know, treasury bonds, US treasuries, are the dominant form of collateral in the whole world. So this is what countries use as collateral to borrow assets. There's lots of liquidity and a lot of places to borrow against your bonds. You can go to a bank, you can go to a brokerage. I've never borrowed against a bond, but I know there's lots of places to do it, right? And since bonds are so large and stable, you don't have to worry about your collateral fluctuating as much versus if you were to use something like Bitcoin, which I do believe in the future will be the dominant form of collateral over the internet in the next coming decades, as we go deeper into the great wealth transfer, but that's a topic for another video. Yield farming, however, we have it as lower because you can borrow against your yield farming positions, but it's new, it's more risky. It's only a few protocols that can do it. You can't do it at a bank. You can't do it at a brokerage firm. Only on a decentralized application, we have to trust the code. It's risky because, crypto is more volatile than bonds. And I did make a video on the protocol where you can do it on. It's called Yielder. You can borrow against your Uniswap V3 positions. Feel free to give that video a watch if you haven't. But just given that it's not a lot of liquidity, it makes it harder to borrow against your yield farming positions if you're a whale, right? So institutions won't be able to do it, but all institutions can borrow against their bonds, okay? All right, next, we're gonna talk about cash flow stability. How long can you bank on getting cash flow from bonds from yield farming? Now, I actually meant to put this as green on bonds as well. Green for bonds and green for yield farming. Let's elaborate. Now, with bonds, it depends on the bond, right? If it's a corporate bond, you have to trust the corporation. I'd be way more comfortable buying bonds if it's issued by Apple, Microsoft, Nvidia, Google, Facebook, Netflix versus, some small company that no one really knows about. Also trust the long-term stability of treasury bonds, right? Because it's backed by the US government. So if it's a junk bond, then, wouldn't trust it as much, but that's why you're compensated with a higher coupon rate or a higher yield. Now, with yield farming, you get paid passive income block by block in real time, just as long as you're in range versus bonds. I think you get paid on a monthly basis. And if the volume increases, you directly benefit because it results in you filling more orders, which means you're making more passive income. If a company issues a bond and they release their earnings report a month after and it's high, the price of the bond may go up, but the yield won't change. So, there's always some trade-offs there. And that's also on the way down. Like if it goes down, the yield won't change, but the price of the bond may go down, right? Now, obviously with yield farming, if the pool that you're in goes out of range, you can rebalance it or find a better pool in less than 2 minutes, honestly, if you know what you're doing. And then you're right back to generating passive income. All right, now let's talk about saturation. How likely is it that a big player can come in, saturate the yields? Let's elaborate on this. Now, again, with bonds, it depends on the bond. You probably run out of corporate bonds first before you run out of treasury bonds, because if there's a company that's in high demand, that's doing really well, and they issue bonds, they can all get bought up, right? And obviously the yield also depends on the interest rate. So I put moderate on there for bonds because it just depends. The government can also always issue more treasury bonds because they're in bed with the Federal Reserve, so they can always pay out because they're printing money. But for corporate bonds, municipal bonds, zero coupon bonds, junk bonds, the same cannot be said. Now with yield farming, it's a higher risk of saturation because if people, it's a higher risk, but it's also not. Like right now, it's not as much because it's just retail investors who can provide liquidity. Like I said, the mainstream banks and financial institutions aren't legally allowed just yet. So in that way, it can't be saturated. But if people or a large whale finds a good pool, they can saturate it immediately. But on the bright side, if you know what you're doing, it's pretty easy to find another good pool to jump into. Like right now, especially with the big dip that we had in ETH, you can get triple digit yields, sometimes quadruple, on just an ETH USDC pool, Once institutions are granted the regulatory green light, that's probably going to be the first one that they hop into, and the yields will get saturated 100%. All right, now the next one is risk of loss. How likely is it that you can lose your capital after you buy a bond or begin yield farming? For bond, I have it as high. For yield farming, I have it as moderate. Let's elaborate. So again, with the bond, it depends on the bond. If the riskier the bond, the more likely you are to lose it because it's riskier, and the more likely they are to default. Okay? Corporate bonds can default, municipal bonds can default, junk bonds damn sure can default. And if we're being honest, the U.S. Treasury bond can default too, but as long as the U.S. dollar is the world reserve currency, people are always going to desire to save in that currency. So I don't see that one defaulting anytime soon, at least. With yield farming, there is something called impermanent loss, right? To where, let's say you're providing liquidity in the ETHUSDC pool within the range of 2,000 to 3K. If it goes above 3K, you're in 100% USDC. If it goes below 2K, you're in 100% ETH. It's pretty much a limit order for the underperforming asset. Now, the risk is the decentralized exchange can get hacked. Now, this is why we teach our parliament members to only provide liquidity in 2 assets you wouldn't mind holding on its own, and on a decentralized exchange that has a good amount of audits that's battle tested, such as Uniswap, Aerodrome, Trader Joe, just to name a few. But you kind of have impermanent loss with bonds too, because like let's say you buy a corporate bond and it's a 5-year term, and 2 years in that corporation files for bankruptcy. I don't know if that yield's still going to get paid out. It probably won't, but you can damn sure bet that the price of the bond will drop, because who's going to want a bond from a company that just went bankrupt? All right, last but not least, long-term stability of both industries, the bond industry and the yield farming or market making industry in crypto. We have bonds as high, yield farming as moderate. Let's elaborate. We have bonds as high because I don't think the bond industry will ever go away. People and businesses will always be raising capital. They will always be raising capital via equity and via debt until the end of time, I think. So I don't think that will ever go away. Yield farming, I have it as moderate because yield farming is new in crypto, but like I said, it has existed in traditional financial, in the TradFi world for centuries. The only reason why I put it as moderate is because I don't think it will go away, but I don't know how regulation is going to shake out. I don't know if they're going to say, hey, you have to have some kind of license to be able to do market making or something like that. So it won't exist in this capacity. Definitely things are going to change. I just don't know what, but I do know it's not going away, and that's why I put moderate. So for those who stuck around to the end of the video, I want to conclude here. When would I get to each one and why? So in my opinion, crypto is the best asset class to educate yourself on and get into, as the returns are asymmetrical with high upside and not a lot of downside, as it's the smallest major asset class. It's kind of like investing into the S&P during the roaring 20s, right? Crypto will be a multi-trillion-dollar asset class in the next few decades. So whoever invests will get to ride that wave. And obviously yield farming offers a great way to passive income. So crypto is a good asset class for growth. Bonds are a good home to maintain wealth once you have lots of liquidity. Like if you're a billionaire, it's going to be hard to do yield farming, right? Because it's not that much TVL in DeFi right now, at least in the pools that you want to get in, right? That you want to get in. So if you have lots of liquidity, you can buy bonds, outpace inflation, not lose capital, because once you get to a certain point, it's about maintaining what you have versus, trying to grow. Also, it's cool to use bonds as collateral so that you can still have the bonds, but you can get higher returns with the funds you borrow without paying taxes, because you don't pay taxes on borrowed funds. So just to quickly summarize, yield farming in crypto, growth, bonds, maintenance. So with that, if you got value from this video, I ask that you drop a comment, drop a like, subscribe, share with a friend. I am going to do another video on yield farming versus dividend paying stocks. If there's another form of passive income that you want me to compare yield farming to, let me know in the comments and I'll do it. But with that, I thank you so much for tuning in. I love every single one of you watching, and I'll see you in the next video. Take care and trade safe.